On this series, I'm going to share with you guys some knowledge about volatility and liquidity. Hello everyone, it's your boy Captain Jerry here from Fishing for Pips, and we're going to break down these two things. Alright, now volatility, pro traders always lean towards volatility. Retail traders, on the other hand, always lean towards liquidity. So they're always looking at these little fast spikes, London breakout, 1 minute time frame, 5 minute time frame, 50-minute time frame. These little New York session, when it open spikes, London session when it open spikes. Nice, they look at that as liquid. They look at a little 50-minute candle, run of 50 pips, 25 pips, 30 pips, and they say, oh my God, that's volatility. It's very volatile, but that's just liquidity. That's just fake out. That's just traps. Yeah, that's nothing. That's just things to catch people thinking irrationally, rushing trades, just to stop some traders out who are very close, tight stop loss, looking for perfect entry, over leveraging, blowing their account, putting them in margin trouble. Nice. That just to entice them to take trades in the wrong direction when they see price. They call it momentum candle, and they see the price spike up and they try to chase it. Nice. That's what they're doing. They're sitting there watching the graphs and trying to market execute. They're getting up 3-4 in the morning, nice, looking for these certain little spikes and stuff and trying to trade it. That's why they're suffering. That's why they're not making good money. That's why they're struggling. They're doing everything the wrong way, the opposite way. Everything is against them. They're chasing liquidity. So retail traders chasing liquidity. Pure traders, they lean towards volatility. Liquidity, 1 minute time frame, 50-minute time frame, 5-minute time frame, lines and indicators, randomness. The trading are part of financial markets that you cannot win against consistently. I guarantee whatever you make, you can't keep, you're going to lose it back. And I guarantee you're going to lose more money than make money. And I guarantee you wouldn't grow a large trading account and make good withdrawals and become successful in trading. You're going to struggle, you're going to be up and down like a roller coaster in your trading account, and you'll eventually blow your account over and over and suffer. Yeah? I guarantee, with all your lines and indicators and your Fibonacci and your moving average and your support and your resistance and your technical analysis, your sentimental analysis, your fundamental analysis, and all the other things that you do, nice, you are trading liquidity, you are chasing the wrong thing, and you're in a place in financial markets that you cannot win against because the market makers is against you, the algos is against you, yeah, all the traps of financial markets is against you. You already know who you're up against and what you're up against and what you need to do to position yourself in an area of financial markets to make money. You just follow hype, follow news, follow Google, yeah, follow influencers, YouTube, nice, read some book, hear about some strategy, and here you are. And you might talk it, say it, and go and teach it. You might do videos on it. You might share stuff on it. You might tell people you're an expert, you're experienced, and you know what you're doing. And you're trading in a part of financial markets. And that's why I say, not because you hold a trading account means you're a trader. You can have a trading account, be clicking buy and sell every day, and you're not a trader. A trader have a specific framework that makes them a trader. You can just hold a trading account and be guessing and gambling and trading in a part of financial markets that you cannot win against. So, it's very random here. 1 minute down, 1 minute up, 1 minute down, 1 minute up. So all this noise, all this chaos, nice, and this is liquidity. You trying to trade this Monday to Friday to make profit for income, yeah, for your extra income, to build wealth, to retire your job, to retire your mom, your dad, your wife. You trying to trade 5-minute time frame, 5-minute time frame, 50-minute time frame. Yeah, you're on the 5 minute, you're on the 15 minute. Nice, you're on the 1 minute, and you're killing yourself down there. Volatility now is a long, sustained running price, where price trades from one price level to the next. Like the quarterly levels, the price moving 1,000 pip increment moves. It's a numbers game. Nice, so they set the price. If you look at a business and I go share something, there's a price to be set and sold at a certain price for them to make a profit. It's ain't just the bidding and asking, but it's a numbers game in trading also. how they set the price, how do they actually move the market to make profits. Nice. What traders are actually doing who are speculating of the thing the market going long or thing the market going short. The price is actually being set at a certain price level and then slowly trending and moving straight to another price level. Then it corrects and comes down. Nice, and then it resets and then it goes again to another price level. So we got these long sustained runs. That is volatility. All this liquidity stuff is actually making up this whole run of volatility. And people trading inside of them little chop up and down, kind of stick up and down, but they're not seeing the bigger picture of price moving from one price level straight to the next. So they try to make money daily because they think, well, trading long term or swing trading or medium term trading here, why would they wait quite here? Why would they wait 2-3 weeks to make $5,000, get rich slow, when they could jump in here and over leverage and make the same $5,000? So they find the longer term approach ain't too good for them because they want to just, I can make it 5,000 right here. Why should I wait all here? So they try to get rich fast. They don't want to get rich slow. They make the money here, give it back here. They make the money here, give it back right here. They make the money here, lose it back right here. They make it here, lose the money right back here. We making the money here, keeping the money, and catching the next move and keep adding to what we make. And we're getting rich slow, but we're getting rich for sure over a period of time. Them trying to get rich quick, trading inside here. This is liquidity. This is volatility. And this is where the news will be spiking up and down and they're trying to trade that. We trade in here. We are far away from all of this drama. The news is coming in every week and pushing the price up, pushing the price up, pushing the price up in our direction. They don't know what price. The price going up, down. Today to buy, tomorrow to sell. Today to buy, tomorrow to sell. We position ourselves and we buy again, and we buy again. They're trying to buy low, sell high, buy low. We buy here, we trade out the whole cycle. Yeah, this is a lot of randomness. The trading are part of financial markets here where the broker full in his pockets. They're not full in their pockets. They don't understand volatility. Volatility is that fluctuation of price. So in stocks, when we measure volatility, we have DOR, distribution of return. So we can go on our stock and get the data for 50 years ago, 70 years ago, and we run it in the formula on our Excel spreadsheet that calculates the volatility, and we can tell what time horizon the volatility in. We can look at how much years the volatility has been in a certain area. That's why we know retail traders are not successful. That's why we know that they are not succeeding, and that's why that's how we know they do not have an edge, because we can literally measure it and see where the volatility is. So we know they're trading in a part of financial markets where there is no volatility. The volatility is that long sustained run that we see on a daily, on a weekly. That's volatility. It's 3 consecutive volatility runs, one after each other. That's a cycle. They are actually on a 15-minute close up the price. So they don't come out on a monthly, they don't come out on a 12 months, they don't come out on a 6 months, they don't come out on a 3 months, they don't come out on a monthly, they don't come out on a weekly and a daily and look at the bigger picture. Even if they don't even know how to properly well assess it, because they have support here, resistance here, and all kind of line and indicator, trend line and stuff all over the place. They don't know how to actually count the structures inside with the patterns, the counts, the phases, the cycles, the levels. They don't understand the sequence and the frequency between the different time frames and the cycles playing from the smaller time frame come up, and you can actually read it from the bigger time frame come straight down. Nice, because one level on the monthly is 3 4 hour, 1 4 hour is 3 1 hour, 1 1 hour is 3 15 minute, 1 15 minutes is 3 5 minute, and 1 5 minute is 3 1 minute. So they don't understand the sequence coming up or going down, and they're trying to beat up in this part here. So even if they look at the smaller time frame and they come down here, they're done lost, they're done confused, they don't know what they're doing, they're applying the lines here, the thing they get a directional bias here. The thing they get a downtrend projection or uptrend projection, They don't even know when the market is going to contract, when it's going to correct, when it's going to retrace, because they don't have the knowledge of how to track the cycles and how to know when the market is too negative GDP, a positive and a negative, where the market will come out from a correction and start to trend up, or come out from a contraction and start to continue the trend, or come out from an uptrend and start to actually retrace, pull back. They don't know how to read that properly. Lines, indicators, and they're trying to trade on a smaller time frame, and they're chasing liquidity and blowing themselves up. Here, the buy up here, market drop. The sell down here, market rise up. Yeah, right through. Yeah, they try to sell here, market come up. They try to buy here, market drop. So like market hunting my stop loss. The market is hunting your stop loss, you just trading crazy, you just don't know what you do. You try to sell here, market come up. You try to buy here, market drop down. You try to sell here, market come up. Yeah? And you're just blowing yourself up right here over and over. The bigger time frame shows you the bigger macro view, the bigger picture of the cycle, and then you have to go down inside the cycles and actually start to read these smaller time frame cycles. And now you'll get a proper big picture of where you are, the phase of the market that you're in, nice, your forward implied volatility outlook, so you can know your expected returns, because you have something called ADR times 3. The same measurement of the first level when you measure it, if it's 1,000 pips, nice, 2 is going to be approximately the same and 3 is going to be approximately the same. So we already know the type of return that we can get on the other volatility run, nice, before the cycle play out. And the cycles can run consecutively because it's have monthly cycles, daily cycles, weekly cycles. So when the cycle over, the trend don't need to reverse. It could just retrace, reset and go again. Retrace, reset and go again. But eventually when the major cycle actually complete, it's going to actually do an entire trend reversal. This is where you don't try to trade again. You turn the whole bias all the way around. So we know how to read that, because we understand how the market makers make the cycles up, how they create the trading environments, how they set it out to actually achieve their goal and make money. Retail traders are blinded, but we use the two indicators, the two most powerful indicators in financial markets, eyes and understanding. We have the information in our head, yeah. We understand how they are making it up. We put ourselves in their shoes, and then we use our eyes to observe, monitor, and track what they are doing, and then we position ourselves in the best phase, and we use the news events, red folders, volatility to get pushed. And we only use buy stops and sell stops, no buy limit, no sell limit, because we don't want to take our position in front of a moving train and the market just activate our limit and then run straight into our stop loss. We want them to come up, we put the stop loss here and give them time to turn and roll over and come down. We don't want to have price here, put a sell limit here, put the stop loss, and it comes activated and just run straight up. We want it above first. Yeah, create some structure first. Then we catch the trend reverse. We don't want our buy limit here, stop loss here, and then the market come down. We put the position in front of a moving train, it activates the position and run straight down into the stop. We don't want that. We want to actually let it come down, create some structure. Nice, we see there's catalyst in place, news event in place, everything, red folders. Good, we put the buy stop and make them make the turn and come to us. So price is always coming towards us. We are never running. Price needs to be going away from us, and we can track the cycles and then put the pendulum in place for when it come back up. Nice, we are never chasing price. We let the price come towards us. So we always use them buy stop and sell stop. So we could be working, playing, driving, doing what we're doing, sleeping. The market could move big in London, Asian, whatever. We don't have to be there to market execute. It executes itself. Nice, and then we leave it to run within the 1 month to 3 months, or the 20 days to 60 days, and sometime within 3 weeks, we done out. Volatility high and nice, boom. We collect the 1,000 in 3 weeks, we collect it in 4 weeks, we collect it in 1 week sometimes, whatever. Nice. We trade different market conditions, whether it's ranging, whether it's trending up, whether it's trending down, whether the market go up and correcting, whether it come down and correcting, whether it resetting and rolling over. All this market condition we are taking advantage of. Yeah? But this liquidity stuff here, you don't chase liquidity in financial markets. You always lean towards volatility. Ask any professional trader on the inside of the industry, any licensed trader, any hedge fund trader, any portfolio manager, any investment bank trader, any proprietary trading firm, real prop firm, not them fake prop firm out there, real proprietary trading firm. You will actually see, number one, they use a portfolio. Number two, they always lean towards volatility. They're always looking for the returns on a quarterly time horizon between this time frame, just like the banks. So I hope you guys learned something. Lean towards volatility. Stay on the bigger time frame. We're going to teach you guys how to do this properly to kill it in financial markets for 2026. Yeah? So all new students, all senior students who failing, don't know what you're doing, struggling to make money in trading, lacking confidence, yeah, you try so many things and never get through. Welcome to Fishing for Pips. We're going to save your life. We're here to save you. That's what God sent us here to do. We are here to save you. See you on the inside.